Good evening, everyone. My name is Ellie, and I'm serving as the moderator today for the Industrial Real Estate event. Our event today is sponsored by both the Corcoran Center for Real Estate and Urban Action and the Schiller Institute for Integrated Science and Society. The Corcoran Center was endowed by the late Joseph E. Corcoran 10 years ago. The Corcoran Center started as a single class hosted in the Carroll School of Management. Today, the center's interdisciplinary engagement has grown to 10 classes, an internship program, an annual case competition, and on-campus and off-campus engagement, including events like this, the second annual Real Estate Week. Boston College's Schiller Institute for Integrated Science and Society is designed to create multidisciplinary, collaborative research processes to address critical societal issues in the areas of energy, health, and the environment. Without further ado, I will briefly introduce our guests tonight. Tonight we will have Nicholas Rita and Charlie Forbes joining us. Nicholas is currently serving as a senior economist at CBRE. Nicholas's core responsibility is to dissect and analyze key trends within the U.S. industrial property sector. Charlie Forbes is the chief investment officer at Cabot Properties and works on core investment strategies. Nicholas will give us a brief presentation, and then we will have time for moderated questions for both of the panelists at the end. Please join me in welcoming Nicholas and Charles.
Thanks. Much. Thanks for everyone for coming. It's great to be here. I flew in from Phoenix. It's only my second time in Boston, but I actually go to BC as well. I'm in the master's program for economics online, so it's good here to see the campus. Hopefully I can spend some more time here. But as was already mentioned, I'm the senior economist for CBRE Econometric Advisors. So we're kind of an umbrella company. We're kind of under the umbrella of CBRE. We're an independent think tank. Now, it was originally founded by Ray Tordo, who's a Boston College alum, and Bill Wheaton, who still serves as a professor at MIT. So we're responsible for all market research and forecasting for all your major property sectors at CBRE. So today, I'm going to give you a little bit of a background of kind of what industrial real estate is, the value, the purpose, some of the things you might not know about, and then I'm going to go into a little bit of the fundamentals, some of the data we use, and some of the data that our clients use to kind of make investment decisions, leasing decisions, and property management decisions. So I'm going to kind of zoom out a little bit. So trying to kind of understand what U.S. industrial is. And kind of a lot of people aren't quite sure. They might view it simply as, the large Amazon warehouse, and then that's true, but it's better to kind of view industrial real estate as a conduit for facilitating trade. So really connecting the production of goods to the end consumer and kind of filling in that equation in between. How did we get from 20-day delivery expectations to sub 3-day delivery expectations? That's really a build out of the industrial logistics pipeline, and those are the problems we're trying to solve. Some of the modern relevance that's going to kind of pertain to you is e-commerce. It's a really significant driver for industrial real estate, both from a demand standpoint, as well as a capital markets and value standpoint. So as more and more consumers have purchased goods online, we've had to facilitate those new purchases. We've had to facilitate the increased delivery expectations. And then there's a new demand. There's a new shifting demand for different types of goods. So we've seen the growth in grocery delivery and some of the food prep delivery. So that's really spurred a lot of growth in cold storage, which is kind of subsector in industrial. I'll get to that a little bit later. But just kind of as the demand changes, we're getting a lot more subsectors involved depending on really what the consumer does. There we go. So I'm going to break it down a little bit more. So I kind of mentioned that large Amazon warehouse that kind of stores goods. And that's just kind of one component of it. And that's really going to be your key warehouse and distribution space. So this is primarily meant for storing inventory and kind of handling inbound purchase orders like we make every single day. Then you kind of have your flex space. So this is a little bit more of a hybrid. It includes dedicated office space, retail space, some distributions, but has some overall industrial applications. Then you have R&D, which is pretty popular here in Boston. You're also going to see it in San Diego, some of your other kind of high R&D markets. They include a lot of wet labs, dry labs, but also have kind of a distribution manufacturing component to it as well. Showroom space, not as popular. You're not going to see as much of it, but kind of retail display, but also kind of handles their own distribution. And all these different types of assets are going to have varying rental rates. They're going to have varying values, and they are going to vary market to market. So you're going to have markets that are considered large warehouse and distribution markets. You're going to have markets that are considered more R&D flex markets. San Jose is a big one, or kind of the Bay Area. And a Bay Area has so much flex space that like fundamentals in the Bay Area almost track Silicon Valley more than they track the rest of the industrial real estate sector. So it's really good to have an understanding of when you're looking at a particular market, what's the space allocation? Breaking it down even further, size is incredibly important when you're looking at a particular asset type in industrial. So you're going to hear a lot of terms and they kind of mean the same thing. And the first thing I'm looking at here is light industrial. These are typically warehouses under 100,000 square feet. They're small. They don't have all the modern amenities. They don't have really large ceilings. It's really about location. You're going to find light industrial buildings kind of closer to an urban core. And it's really meant to satisfy delivery expectations. Can I get something delivered the same day? That's going to be your light industrial. You're going to hear it called shallow bay, small bay. You're going to hear it be called infill. They kind of all mean the same thing. But these are smaller assets where the value is really proximity. You got bulk assets, pretty much going to be 100,000 square foot plus, probably between 100,000 and 200,000. Big box, 200,000 square feet to probably about 500,000. Then you got your mega big box, 500,000 plus. So those are your Amazons, your Wayfairs. They have a lot of those 500,000 million square foot distribution centers. And I'm going to pivot to the right side of the screen. Light industrial, again, synonymous with kind of the last mile conversation you're going to hear a lot about in the industry. So again, older, higher value on location opposed to like physical attributes. Then you got your regional distribution centers. So these are light industrial or bulk buildings, but these regional distribution centers really mean to service kind of one metropolitan area. So you'll have a distribution center that'll service metropolitan Phoenix primarily, Boston, etc. Then you're going to move to kind of multi-market distribution. Now your assets are getting even bigger here. So these assets are going to serve multiple markets, and they're going to be closer to transit hubs like rail, intermodal facilities. Now these can service multiple regions. And then lastly, kind of your gateway distribution. So these are your mega big box assets, typically close to like large international trade, wet ports like a Savannah, a Charleston, kind of that initial storage of inbound goods where kind of inventory management is going to first take place, and they're going to determine allocation from kind of that main facility. So that was a little bit kind of a breakdown of some of the structural components of real estate. Now, what drives more industrial real estate? Why are we building more? Why are more occupiers leasing on industrial real estate? And these are kind of your main drivers. And they're going to be trade. We kind of seen that post-pandemic. We were importing a lot more physical goods. E-commerce, the growth in purchasing goods online really accelerated this conversation as well and put a lot of strain on the logistics footprint. Employment and inventory control. Now, if I'm being honest, you could probably just put employment up here and remove the rest. An employed population is a population with money, and they're going to buy goods. And in our forecasting models, that is our exogenous demand driver, is total non-farm employment. Historically, the literature supports that employment has the best correlation with demand for increased industrial space and construction. All right, so now we have a little bit of a base understanding of industrial real estate. I'm going to go into some of the fundamentals that we look at, and Cabot will look at when they're making a particular decision. So this is from my latest house view deck, or my market overview for industrial. So what you're looking at here is an analysis on the current availability rate and the 10-year historical average availability rate by market. So when I say availability rate, I'm looking at the total stock of industrial warehouse space in a particular market and what percentage of that entire stock is listed as available for an occupier to lease. All right, so a lot of a similar conversation you might see on the residential side. It's the same kind of application here. So what I'm trying to look at here is, where did the markets look like? What did the markets look like in Q4 of 2022? And what did the markets look like in Q4 of 2023? So in Q4 of 2022, a lot of your large kind of key markets had an availability rate below their long-term average. They're performing very well. Space was tight, rates were high. It was extremely competitive. And the story here is, what a difference a year makes. So I do the exact same chart and I look at it from Q4 of 2023. And now you have a lot of markets that have an availability rate above their historical average. So we've seen a lot of softening in industrial. Lower leasing velocity, some increase in the sublet space. So where occupier is leasing space, but they're now going to lease that space to get out of it. So a lot of markets have seen softening, not all of them. You'll notice that Chicago is a pretty stable market historically. It's one of the benefits of a market like Chicago. It's not very volatile. Riverside, you might hear Riverside. It's also called the Inland Empire. Depending on what company you're working with, you're going to hear a different term for it. But the general story of the past 12 months has been a industrial real estate market that has seen some pretty notable deacceleration. All right, so this chart, it's not fancy, but it tells a really good story. What you're looking at here is the availability rate on assets that actually get delivered. So a building completes, it gets its certificate of occupancy. What is the availability rate at that point in time? So we're looking at where the market is now relative to the average since the beginning of 2018. And this is important because it's somewhat of a leading indicator for developers and investors on how healthy is the leasing environment before an asset's completed. If you have the bulk of your under construction pipeline leasing before it's ever finished, it's a very positive indicator. And that's kind of what we saw right there with that dip. We're in a situation now where the average availability rate on a building that gets its certificate of occupancy is about 62%. It's quite high. So again, it's an important trend for developers to understand if they're trying to gauge how quickly can they lease their building. There's some risk associated with it. You'll notice the theme here is availability, and it's an important theme. So kind of continuing along that, I've kind of broken down the availability rate by size cohorts. Now, we looked at size cohorts when I first started, when I mentioned kind of big box, mega big box, light industrial. They kind of have a corresponding square footage down here. And we're looking at kind of the peak and trough by size cohort. So kind of zooming into the end of the chart, you'll notice that 750,000 square foot plus building cohort had a pretty sharp increase as of late. An asset that big is less competitive from the standpoint there's only a handful of occupiers that can lease 1 million square feet. You could probably list the occupiers yourself. So when leasing velocity slows and a few of those occupiers are, on the sideline, there's not that much competition to fill that space. So the availability rate had a pretty steep increase. And you also notice kind of that smaller asset, that 25,000 square feet, about 200,000 square feet. It's weakened a little bit, but the slope is not nearly as severe. So if you're a fund or if you're an investment firm and you focus kind of on small bay infill assets, it's kind of a positive trend for you. On the flip side, if you're more of a big box type investor, this might be the conversation you need to kind of shift your strategy more towards smaller assets. So it's really important to get an understanding of which size cohorts are performing compared to each other. Once again, availability rate. So we're trying to gauge here supply pressures. So we built an unprecedented amount of industrial facilities the past 24 months. And there have been concerns that maybe we built too much. Too much is relative. So what I did here is I took the current under construction pipeline by market as a percentage of the total stock, just to keep it in context, and then compared it to its current availability rate. And looking at the two, I was able to kind of identify, which markets are kind of at most risk of potential oversupply. Austin, Phoenix, and Savannah are markets with high availability rates and a high UC as a percentage of their stock. So there are some risks there. Now, Savannah built out its market incredibly fast because of how quickly we were importing goods post-COVID. So it was very responsive to we moved away from services, we moved only to goods because no one could leave their house. Now they responded very quickly to that, and they really built out their stock. Now there are concerns with Savannah. It's primarily just meant as a trade facilitator. It doesn't quite have the demographics of like a Los Angeles to support it, a huge population, people spending money. So there are some concerns that Savannah got a little bit ahead of themselves. Phoenix as well. Phoenix is purely a demographics play. It's jobs, it's retirees with money, and that's what they were trying to capitalize on. Kind of on the flip side compared to Savannah, not really a trade facilitator in that sense. And I think at the moment, Phoenix, from a total square footage standpoint, has the largest pipeline in the country, which is shocking if you are within the industry, and Phoenix should never really be number one on your list. Austin's a tricky case. A lot of people thought Austin was going to be a market like Dallas, like a Houston, centrally located, can reach a lot of geographies kind of in a short amount of time. There's some limitations to Austin. A very small airport, doesn't have a lot of rail. It's purely a demographics play. A lot of companies moved there. It's affluent, etc. But a lot of people kind of lumped Austin in with some of the other larger distribution Texas markets, and that really wasn't the correct connection. So it seems some softening there. I looked at kind of availability on the availability rate for completed buildings. Now we're kind of looking at the inverse of that. We're looking at the pre-lease rate on completed buildings. So same conversation, but kind of the most important chart here is the green one, or the most important bar here is the green one. We're looking at construction starts. So we've seen construction starts decline pretty considerably, and they pretty much align with the rate hikes from the Fed. So these are very interest rate sensitive parts of real estate. Building out new facilities, it's very expensive. Construction financing has been incredibly challenged with the rate hikes, and they're not getting any types of concessions with lower land prices. So we've seen a pretty sharp drop in new construction starts for industrial, which, if you ask me, I don't necessarily think is a bad thing. To me, I like it when I see a real estate sector kind of respond accordingly to market dynamics. It would trouble me if the trend continued despite rate hikes. That signals to me there's some sort of malinvestment or some disconnect on fundamentals and expectations, kind of what we saw in 2009 when everyone was just building office buildings even though they weren't leasing. So I don't necessarily think a trend back towards equilibrium is a bad thing. To me, it's a healthy thing for the sector. Now, if you own a warehouse, maybe you might have a different opinion on it, but I'm in research. So, getting a little bit of an understanding of who leases this. Yes, go ahead.
I'm just going to ask you, a lot of people in the industry seem to think, in a lot of major U.S. cities, the industrial sector is going really strong. So you're saying there's a little bit of a dip, but you think it will continue to climb in 2024?
It's going strong comparatively. If I was to compare it to office, it's not even a conversation. But yeah, the industrial sector really wasn't, pardon my French, the sexiest sector of real estate if you look back at 20 years. And now all of a sudden it's at the top. And again, there's been some weakening, and I think I'll probably be more bullish than most on the sector. I don't really buy the narrative that industrial is just going to continue this downward trend of softening. I just think what you're seeing is a little bit more of a push towards equilibrium. 2% availability is not sustainable, and I don't know what world you think it's going to be. Delivering 500 million square feet of warehouse every year is not sustainable. So I don't want to confuse slowing fundamentals with a sector that has any structural deficits to it. I don't think it does. I actually think it's in a very healthy spot. But yeah, looking at some of the trends from the occupier side of things. So again, it kind of mirrors the story of, there's some weakening. Now, some things of note here. One, e-commerce. Pretty notable drop in total leasing activity from 2022 to 2023. A lot of these occupiers are tied to the housing industry. You could probably list them. Wayfair, Home Depot, etc. So when rate hikes jumped, housing sales slowed, they were less inclined to lease space. Now, manufacturing also took a dip. Now, that might also go against some of the conversations or some of the narratives you read online about this mass onshoring and mass nearshoring. It's kind of purely anecdotal. It was kind of more wishful thinking that everyone was just going to uplift production from Vietnam and move it to the United States. It's very complicated. It's very expensive. You have financial obligations in those countries. It doesn't always make a lot of sense. So I really try to point out that manufacturing is really not off trend. We're still producing pretty much at the same growth rate as we have in the last 10 years. And it kind of shows up from our leasing volume standpoint. Third-party logistics, kind of a best way to put it, maybe your WeWork of industrial real estate. So they'll kind of handle a lot of your inventory management. They'll lease the space ahead of time, and then they'll kind of handle inventory management, storage, etc. Typically going to be your largest leasee of space, kind of 100,000 square feet and up. But on the whole, we are seeing a slowdown in total leasing activity compared to 2022. All right, my last 3 slides, and just so everyone has time, I'll go through quickly. This is our bread and butter. This is what our clients pay us for. These are our forecasts. So what you're looking at here is net absorption and availability rate. Now, you heard me ramble on about availability rate. Net absorption, that is our metric for demand. If I move into a 100 million square foot building, that is 100 million square feet of net absorption. It's how we measure demand. If I go from 50 million to 100 million, that is 50 million square feet of net absorption. So right now you can see the corresponding increase in demand post-COVID, and you've seen the slowdown kind of in 2023 corresponding with the rate hike and just some broader macro volatility. Now, it's our expectation that it's going to improve and moderate. We have availability right now at about 7%. We think it'll remain quite flat in the short term because we think a lot of those larger occupiers are going to come back to the market in 2024. Industrial completions, again, astronomical level of completions. You're looking at about just under 500 million square feet of industrial space completed in the United States in 2023. I mean, it's just record after record was broken, 2020, 2022, 2023. So you saw that kind of decline in starts, which is kind of what's feeding that 2024 drop. So that's about a 27% drop in completion activity expected in 2024, which is great. Less space hitting the market. Well, it's great depending on who you are. If you're a tenant, or if you're a landlord and you have less space on the market, tighter competition has varying impacts on your rental rates. Rent growth. So again, tale of 2 different cycles here. Looking at 2018 to 2023, compounded annual growth rate was about 6.7%. So these are the rents that landlords are charging occupiers to lease their space. It's incredibly impressive, 6.7%. Now, it's our expectation it'll be much more appropriate at about 3.5% from 2023 through 2028. This is important. The implications here are, if you have a large portfolio and the leases are expiring soon, getting an idea of the growth rate for rental rates in the future is really important to make those determinations on if you want to get those renewals or if you're looking for a new deal. Lastly, this is our year-over-year rent growth by scenario, so upside, downside, and baseline. From a year-over-year growth standpoint, we're at about 6%, so we're out of the double digits. It got up to as high as nearly 14% in 2022, and our expectations are that year-over-year rent growth will kind of hover just under 4% in the long term. Again, much healthier real estate cycle and essentially back on trend to where we were before the pandemic started. And that is it for the industrial real estate update. Questions? please.
Yeah, so you mentioned how net absorption was kind of used as a metric to estimate demand in your forecast. Would you say in general it's been your kind of forecast has been pretty accurate, or is it kind of tough to be accurate in this industry that has so many variables that?
It's more challenging to be accurate when the market's unpredictable. I can tell you right now, no economist predicted 70% rent growth in the Inland Empire. If you did, bravo. It's very easy right now to predict office. There's nothing going on. No offense. But generally, our models, and we haven't done a full forecast test in about 2 years, but we've been very, very close in our models. We're pretty confident in them. I'm happy to kind of, if you want to connect, I can go kind of into specifics of the regression we use for our forecast. But they've historically been very accurate.
I just wanted to ask, obviously the industrial space in Phoenix has been pretty strong recently. I was just wondering, how do you feel about the two of the biggest industrial developments coming to Phoenix, the TSMC Mammoth, which is $40 billion, and then there's another one that's $21 billion, and they're pretty headline news.
They are. Yeah, so those aren't competitive from a speculative warehouse standpoint. Those have an occupier in place. That's chip production. So you probably wouldn't use that building if you're a warehouse stakeholder in any type of competitive analysis. But it is important if you're looking at the conversation from is Phoenix turning into a manufacturing hub? Should we have space in Phoenix to capitalize on that? That's certainly important just from pure economic growth. I think Phoenix has been competing heavily with Austin, Texas, and a few other markets for that chip production. But just looking at kind of warehouse space fundamentals, availability, absorption, rental rates, a large manufacturer coming in is really not competitive in that sense. They're kind of two separate conversations.
I was wondering, Charles, how you would respond to this, if you are noticing similar trends, if you're seeing different things. Do you have anything to add in general that maybe wasn't touched on?
Yeah, and just a little history. Charlie Forbes. I work with Cabot Properties. I've been there a long time, so I'm one of the old time warehouse folk, I guess. The guy who was supposed to come here was a lot younger, has a lot more hair, probably more interesting, and he broke his leg, so I'm filling in for him. But I've been doing this business, seems like almost 40 years. Cabot started as an offshoot out of a development company, Cabot Forbes, which was Boston based. Created the first industrial parks in the country, and then was sold in the 80s. To Marshall Field, kind of imploded, but the pension fund advisor unit of Cabot, which was advising IBM and Stanford, and that basically created the company that we are now. And we had a portfolio in the 90s that was mostly industrial, some office. And in 1998, our head now, Franz Colorado Mansfield, had come over from McKinsey, thought it was a great idea to go public and throw all these assets into a public industrial REIT. We let go. Everyone decided at that point they didn't like office anymore. We were going to do industrial. And the timing was pretty darn poor. We were, fourth on the list of industrial REITs. It was Prologis, AMB, First Industrial, and Cabot. And I joined in 98, did a ton of leasing on the industrial side, and no one cared about industrial real estate in 1998 and 99 and 2000, and our stock was just flatlined. But in one fell swoop, and right after, at the end of 2001, CalPERS bought our whole company at a $24 stock price, and bam, we became the top performing industrial REIT of our, So it was the irony of that. And so we sold out from being public, and then we created basically a private equity fund doing the same thing. So Cabot is a little bit of a maverick in the industrial world. Prologis is the big kahuna. They're an amazing company. Outside of the US, they're amazing. But there's a company down in Australia, Goodman. Encourage you to look up Goodman. I think they are extraordinary. We're building buildings in Melbourne and Sydney right now, so I see Goodman. If I were a young folk and really wanted to get into warehouses, keep an eye on them. But our platform, we've been doing this for large institutions a long time. We run closed-end funds. Maybe someday we'll have an open-ended fund. We've had incredible performance at the time through the last 20 years, really basically putting together industrial portfolios. And we don't focus on the big boxes as much. We focus on mid-sized to smaller warehouses, distribution warehouses, 200,000 square feet is a typical average. And we'll build them, we'll buy them vacant, we'll buy stabilized, we'll put them into a diversified portfolio. So we do a lot of $20 million, $10 million, $30 million deals in winning cities more and more globally. And we put that all into, so we'll assemble a portfolio with maybe 100 transactions, 200 buildings, and we sell it for $2 or $3 billion to folk like Blackstone. So we're an aggregator, and we've had great returns through time. But we see a lot of warehouses, and I love the business. So one of my questions for you is, looking at this, the data, I still think we are in our infancy. So warehouse business, we are still sort of, the pandemic in the last 5 years have brought warehouses to the forefront. Everyone knows Amazon, they're incredible. How many of you have actually seen a warehouse? Have you gone out and around it? Have you seen where Amazon is, or FedEx, or Home Depot? So it's pretty easy. It's all on Google Earth around all these major cities. You can see where the warehouse parks are. Just go drive and see them and check out what they're doing, and you can see inside and see the truck movement. But it's, there's you either get excited by that or not. And I'm one of the weirdos that does, I guess. But we are still in the process of being institutionalized. And our focus is really just on the winning cities of the world. And you can pick them. It's where, these clusters of the major population centers where young people can get jobs. And this is where the wealthiest consumers are. And all we're trying to do is buy warehouses that distribute to those consumers around those markets. And so, there are great, emerging markets, and, a market like Austin has been a high growth market, but, it's, on the list that you had up there, the two markets I was interested in were LA and Miami, and then Phoenix, maybe. And Phoenix is like a live wire because it is totally housing related. And when it goes downhill, it goes downhill. And so it's always been a little higher yielding. It's easy to build there. It's a little bit of an outflow from LA, but LA is the most important warehouse market in the world because it's our most important warehouse market in the US, and we are the top consumers in the world. But all these trends that we've seen happen around the major distribution hubs in our country are happening now in major cities around the world. So we've sort of gravitated from, the big markets in the US are LA, New York, New Jersey, Chicago, Dallas, Atlanta. Those are and if you include Philadelphia, that's the top six, the big six. But more and more, London, and not just London. You have Liverpool and Manchester, and there are 10 million people there. You have Birmingham, you have Amsterdam, you have Munich, you have Paris, you have Sydney and Melbourne, you have Tokyo. Pick your city, but these are major centers, and they are catching up. So if we can get in front of what we've learned in Atlanta, we're simply doing that. So it's, but there are, more and more people are getting into business. Industrial has a habit of building too much. It's pretty easy to build these warehouses. So one of the concerns right now, and we're in the process, we still have this pocket, we're absorbing a lot of these big buildings that were built over the last 3 years and in the last year. And yeah, the demand is down. And if we go into a real recession, vacancy is going to creep up and rents will get impacted. And that's what we're all worried about. But as I go around, there's definitely some leasing to be done in the U.S. And so we're worried about that a little bit. But maybe we don't go into a recession. Maybe we absorb this. And no one has built anything. No one's starting construction now. So there's kind of an air pocket for the next year.
Sure.
Which bodes well for those of us with warehouses. Because if vacancy stays at 5 or 6 or 7%, rents won't get impacted too much. Sorry, that was 15 minutes more than you needed.
I think you answered some of the questions. So, thank you. That was really.
You had a question.
Yeah, I'm just gonna ask: do you see a shift, particularly in North America and the U.S.? Do you see a shift in any other hubs rising out of the blue in the next 10 years?
In the U.S.?
Yeah.
I named the big 6, and I'm a core buyer for Cabot, so I focus really on and that's sort of geographic. And you had a question maybe about diversification, but we purposely, LA, we certainly want to weigh heavily towards LA. It's an incredible market, but you don't want to get over your skis in any one of these particular markets. They all act slightly differently. And Chicago is different than LA, which is different than Dallas. Dallas thinks it's LA, we'll see. And New Jersey and Philly. So you have different dynamics. Atlanta is kind of the conundrum right now. Atlanta and Chicago have always been slightly higher yielding, less growth. Chicago's emerged in the last 5 years a little bit better than others. But most of the GDP growth over the next 10 years is in the southeastern United States. And we are seeing reshoring. We are seeing, major shift on these EVs and major, it's happening in the southeast. So Atlanta, which has kind of been out of the top 6, it's been the one that people like to kick a little bit. And I would bet that Atlanta emerges as stronger as a major market. Now maybe Miami also in the southeast. Miami's been the strongest market in the last 3 years. It is on fire. You see office-wise everything, it's hitting on all cylinders, but it just doesn't have the depth that the other markets have. And there are, you would worry about, there are global investors now that won't buy office product in Miami because of sea levels rising. People don't care as much about a warehouse there, but ultimately that, you don't want to have 25% of your portfolio in Miami, and then when you decide to exit the portfolio, it turns out that the 5 largest investors in the world do not want Miami. That's a problem. LA, has some issues too. Dallas, Texas, for all we know, Texas decides they don't want to be part of the United States anymore, and then we get a problem. So, but the growth there has been amazing.
Interesting.
Could you just expand a little more on what makes LA unique and different from the other hubs you were talking about?
Well, we are the world's top consumer, period. And most of the stuff that we like to consume, that, probably more the stuff we want rather than stuff we need, comes by boat across the Pacific, not across the Atlantic. And it's made, it's not necessarily made in China, though there's plenty made in China. It's made elsewhere. But the Port of LA and the Port of Long Beach are the two combined. They input most of the product that comes into this country. Newark and Port Jersey are the next. Savannah, I'm not too worried about. but things have shifted around to people, have tried to go through the canal and have shifted around to the East Coast. We do have, in the eastern half of the country is kind of important. But the systems are set up for product to come off the boats at Port of LA and Long Beach and make their way all the way to Boston if they need to. The highway network is amazing, the rail network's amazing, and by the way, all these warehouses are amazing. So you have a combination of not only are all our goods coming in there, you also have 20 million people, and it's a nice place to live. It's warm, and hopefully it's been flooded this winter a little bit, but there is growth there, and the infrastructure is incredible. The Inland Empire, if you ever get a chance to drive, the warehouses there are the real deal. It's the varsity. Would you agree with that?
Yeah, LA is one of the few markets that I always try to view industrial real estate as either, are you a demographics play or are you a supply chain play? And LA structurally has both. So if you have a weakening in one, you have a nice hedge. We saw some of the port issues with LA, and it was troublesome, but to his point, still a huge population there buying goods. Kind of on the flip side, some of those East Coast ports, they really don't have that balance if you have a decline in inbound container activity. Savannah doesn't have a huge population to rely on, so they can be a little bit more sensitive. So yeah, in complete agreement on a market like Los Angeles.
Ports are difficult because if you buy a warehouse that stores stuff at a port, it usually doesn't stay there long. So, Savannah, it's kind of like, okay, you have a big Home Depot facility there, but the goods are actually being consumed in Atlanta. I'd rather have the warehouse in Atlanta, close to where people are actually consuming their Home Depot goods than something that's sort of a throughput. You can do that. Houston's a good port because the port's right there where the population is. LA's the same thing, Miami's the same thing, Port Jersey's the same thing, but some of these other ports kind of are, they're 100 miles from where the population is, and the stuff doesn't stay there that long. That said, Savannah has, there's a lot of nice big buildings that have been built there, and they're folk competitors of ours that have done perfectly well there. I don't view that as durable like the top six and mature like the top six markets. The largest institutional owners of industrial in the world are always looking for a greater concentration of product in the top six markets in the U.S. So that's why we focus.
Thank you. I have another question for you guys. You've talked about some of the geographical challenges. What do you think some of the other main challenges are that real estate developers and investors are faced with in today's market right now?
I mean, interest rates right now, top of mind. It's just making it incredibly difficult to get any deal to pencil. You combine that with, you could probably tell the story better than I can, but landowners that really aren't willing to concede on prices, higher construction cost. It's making it very difficult for developers to hit their spread. So this is an unprecedented interest rate environment. I know the expectation is 75 basis points, 100 basis point cut this year, and I think that would be fantastic. Not sure it's going to happen, but borrowing costs are right now top of mind.
Yeah, we're cap rates for core product, or there's a standoff between sellers and buyers right now. But in the core markets, if we're a buyer, we're saying it's a 5.5. If you're a seller, you're saying it's a 5, and the debt markets are saying it should be a 6. And if you're developing and speccing something for to say a 7 or an 8 over core, you're borrowing at 9 or 10 for new construction, and so no one's building right now. It's very hard. There's a lot of capital on the sidelines trying to get into this. So we're doing a few deals right now on the core side, and we're sort of right at about a 5.5. and with bumps, we're sort of like, okay, when is it on an average basis, we're up above 6. Can we get accretive debt over a 10-year period? Yes. But we're sort of looking at unlevered returns that are, call it 8, and with leverage, you're getting a 9. That's a core type return versus value add or opportunistic, which is quite a bit higher. But
Would you take a negative leverage standpoint?
Yeah, just in the short term, if you can. But it's tricky. So it is. Everyone's trying to figure it out right now. There's not a lot of forced selling, and Blackstone looms big in our business. But so does Prologis, and they just did this incredible deal in Phoenix that huge investment, and I think that's a validation for Phoenix, at least in my mind. I like to kick Phoenix a little bit, and you're like, hey, Prologis knows what they're doing, but they got it for a steal, I think. But yeah, I think the overbuilding, these big boxes are a concern. What else on the investor front? There is this. It was easy to build these buildings, and there was an efficiency in that because we couldn't if you plan an office tower, it takes 10 or 15 years to actually get that thing up by the time and you can't time it. So if your office building tower comes online during a recession or a bad time, you're out of business, period. Warehouse is a little more forgiving because you get them built in a year and you can kind of time it and you kind of know when to stop, like what's happening now. There's definitely, you read it, anyone in the Wall Street Journal today, the Central Valley outside of San Francisco, where all the warehouses for San Francisco are, and Stockton, they're kind of they're getting kicked around a little bit. No one wants these trucks in their backyard anymore. They thought they wanted the warehouse, decided they don't want Amazon. It's getting really hard to get approval for the big boxes.
And they don't bring in jobs necessarily. So becoming more and more of an issue, the public pushback on these kind of infill warehouses, they're not particularly attractive. They don't bring in any employment, so you're not going to get a lot of local incentives. And then I've heard from a lot of clients that social media has actually really amplified the voices against particular assets. So yeah, it has been a struggle with pushback on, we don't want the traffic congestion. I don't want to stare at 4 tilt walls all day. Yeah.
But you want your ice cream and beer in an hour. So you need those, which is crazy. We own one of the Amazon robotics facilities in Bridgewater here. And yeah, it's everything within 2 hours. It's crazy. Who really needs it in 2 hours?
Is there a push, like you're saying, people want their products as fast as possible? Is there a push to move like those big mega box square footage warehouses into like the urban centers, or is that something that developers really don't try to do?
Amazon's working with smaller buildings, right? They have their big one. They have everything. Amazon is incredible. They have invested so much in the distribution network and the supply chain, and everyone else is trying to catch up. So they have the big ones and all sorts of different types of big ones, and then they have the mid-size, and then now they have the robotics ones. Everyone's worried about robotics replacing people. My experience has been just the opposite. I mean, Amazon is the more bots they have on the top level, the more people they need on the bottom level. And it's just efficiency. The more the robots make it efficient, but it just makes it busier. And so these buildings employ 1,000 people. It's incredible. But they have connected the dots better than anyone else. And now you're seeing the sustainability front. All the delivery vans are Rivian vans. You're seeing it's pretty cool. And FedEx, they're pretty good at this. The parcel carriers are all pretty good. They're amazing. Home Depot has invested. I mean, we watched the companies that invested in the supply chain over the last 10 to 20 years, and they're the ones that got us through the pandemic. Everyone else is trying to catch up. And that's the big tailwind. I mean, we have e-commerce, but there's still so much of the product is old, outdated, and private in the industrial world. And that's the hard thing, trying to measure all these stats on what's really relevant for Class A logistics space. And Amazon and FedEx and Home Depot have no interest in something that's 60 years old that's still a stat. And most new, food users have emerged, in the last 5 years. They were working off, the average food distribution building was 50 years old. And if you saw where Trader Joe's was distributing their goods and from here in Boston, you would never shop there again. I won't. And so, but people figure that out and they're like, no, we need to have Class A warehouse space where people, you can eat off the floors.
3/4 of the entire stock is over 20 years old. So I think people look at the completion numbers and they think there's just blue chip distribution space everywhere. There's not. And that's kind of one of the reasons we think there's going to be a little bit of a flock to quality in 2024, kind of a fear of, if I don't get my prime Class A space now, someone else is going to get it, because it's not just sitting around. There is a lot of older, less functional space around.
Yeah, I will say, like, LA is one of the oddities, but everyone's focused on these big boxes. There's been new construction. They're hard to get through the approval process now. No one wants the 1 million square footer. What's actually easy in LA are the little 100,000 footers, because no one's really, not as many trucks. It's easy to execute and get that built versus a 1 million square footer. So there actually is an oversupply of 100,000 foot warehouses in LA, of all things. Rents have come down 25% there. It's a point of softness. Now that won't last. That's why I think it's an opportunity, and I'm excited about LA. But there is this thing, well, the small ones start getting built because they're easier to execute on, and no one's really paying attention. So maybe we do see this emergence of smaller format warehouses, maybe some multi-story warehouses. I'm big on focus. We're focused. I think there's an advantage to have a Class A warehouse in an established park with critical mass and critical infrastructure. And if you're in those parks, you got a pretty good advantage over the next 10 years, because it's going to be, no one's going to get rid of the park if there are already but a single warehouse out in a farm field somewhere that people don't like all the Amazon trucks, that's going to get resistance. Sorry.
No worries. Thank you. So another question for you guys, just you touched on this briefly, but when talking about Amazon, you mentioned sustainability. The Corcoran Center is very involved with environmental sustainability and resilience. Could you kind of speak to how environmental sustainability considerations are important in the sector of industrial, or with both of your individual companies, or if there's any ESG initiatives either of you are involved in or know about?
Well, CBRE's top notch on it in our business. They are ahead of it on ESG, but in terms of warehouses, no one's really some of these global companies. It's amazing to me because these are top 100 companies in the world, and if it was their headquarters office space over the last 5 years, they would have been all over this. But for their warehouse in Chicago, I'll give you an example. McKesson. McKesson's a top 25 pharmaceutical logistics company. They're kick-ass. They're amazing. Their warehouse is state-of-the-art, brand new 3 years ago in Chicago. We own it. They're now expanding it. They employ 1,000 people there. And there's not one EV charger in the parking lot that they spec. I'm like, you don't think anyone wants an electric car? They're not, they're just figuring out, the warehouse needs to be LEED certified too. Our office would be. So that's happening, but it's just taken a while for people to focus on the warehouses. There's solar. We have these huge rooftops. Solar is so easy, really easy. And I don't know what the stat is. Maybe Prologis or Goodman, said if all you did was put solar on top of every warehouse in the world, you'd provide like 2% of the electricity needed. Okay, 2%, but why not, right? And so we're big on that. The institutional capital in our business, more and more, maybe less of the domestics, but certainly the foreign. Europeans, investors have definitely led this. They want sustainable buildings. They want them, so making sure that you have, LED lighting, you have proper water, you have solar, you're doing good things. You're holding water properly. I mean, water off these warehouses just sheets. So water control is a big thing. Will we start seeing geothermal? Maybe. In Europe, they're starting to talk about that. But certainly with the EVs and the trucks, and on trucks, big 18-wheelers are different than van deliveries. So I don't know how that will shake out, but I think it's really important. And so I think it's, we're kind of big, easy targets. So to the extent we can help, one challenge is concrete. We use a lot of concrete. That's hard to really, the only way to make it sustainable is less concrete, I think. We're seeing timber make a comeback a little bit in some warehouses, so that's kind of cool. But yeah, there's a focus on it.
And kind of from a research standpoint, what we're kind of looking at now is transitional risk. I mean, are you complying with new regulations? Because that's easier to quantify. It's harder to quantify, is your building going to drop in value for every basis point increase in global temperature? That's a little bit more difficult, but we can start to look at what cities, what states, what countries, are your buildings in compliance? Are they not? And what is that going to cost you? But to his point about solar, it is an incredible opportunity. It's just going to be lagged because you require some pretty significant roofing infrastructure to support the solar. So it's going to have to happen with new deliveries. It probably is not going to make too much economic sense to rebuild the roof of an old building to support solar. The economics really won't add up. But there is potential now in the future to kind of build out the pipeline kind of accordingly.
The global companies that are users the global logistics users are having more and more pressure to solve this. So they're going to want it. Amazon now needs to do it. Oddly enough, their bots get screwed up by the solar on top of the roofs. Just the interference, I think, and I don't know how that all works out, but there has been some. But they're trying to make good on this. All of our buildings are benchmarked in GRESB. So we are now monitoring. There's a whole data grab to the only way we're going to do this is if we measure and benchmark it. So the benchmarking is really important to the global investor base and more to the users themselves underneath. So I think it's improving and we want to have, as we put together a portfolio of 100 buildings, we're not there yet for our value funds, but our core funds, every building that we put together in the fund will ultimately, it will be certified, whether BREEAM or LEED. We don't build them, so we have to, but that means they're benchmarked. We are participating, we'll have, and we just think, our exit in the end, there will be certain investors that won't consider the portfolio unless it's been certified. So if that's in 10 years, we need to be, and in Europe, you're getting rated on buildings are being viewed as abandoned. So meaning that if they don't have, in 20 years, their checklist goes off and says they're not relevant anymore. That's a problem. So yeah, we got to be thinking about it.
Yeah, make no mistake, the biggest contributor though is transportation. Yeah. It blows my mind we don't have more rail in the United States. It's always bothered me. But to see a market like Phoenix start to build out more intermodal facilities, I think that'll be a key contributor to kind of bring down the reliance on those big trucks. We should be shifting more goods via rail.
Well, I think we have time. I want to ask you guys one last question and then open it up to everyone. But how do you suggest that people here at this event today get involved in industrial or real estate in general? Do you have like a specific piece of advice or more about how you got involved or anything you'd offer us here today for a potential career in real estate?
Yeah, I'm probably closer to that decision than you might realize. About 10 years into my real estate professional career. So my advice would be, one, try to get a job in local level research, get comfortable with the vernacular of real estate, what absorption means, what asking rents, taking rents, effective rents. Get familiar with how the conversations happen, understand market dynamics. They're always hiring for local research at any of your big firms, big brokerage firms, your CBRE, JLL, Colliers, and you'll work a lot on specific deals. Teams will come to you. I need a breakdown of this particular area. So I would really get into local research, or, and this might be the next step, become a runner, become a junior broker on a team. It's dirty work. You're going to be canvassing buildings, making cold calls. But I can't think of another job where at such a young age, you're calling clients immediately, getting deals on the table, and kind of just with the sharks right away. Again, it's dirty work, but a lot of opportunity, and you got to get comfortable with the conversation. So when you're in a meeting, you sound like you know what you're talking about without having to force it. And I really just think that kind of starts at the bottom. But I love research. I love data. I like to be in Python. I spent a little time as a broker. I sold one property, took everything out of me. Learned a lot. But that's how I started. And I'm quite happy with it.
It's definitely a lingo. So it's a language
Yeah.
to get used to. Lots of different asset classes. So different types of real estate, different ways to get in on the, ultimately, if you want to be on the ownership side, what do you want to own? Use the public companies to educate yourself. There are public REITs in every sector of real estate. And you can go right onto their websites, and they have investor decks that are PowerPoint presentations, and they are selling themselves. So look up Prologis, and you can see their latest presentation. It's 50 slides. It's why Prologis, why industrial, and why now. And either you get it and you get excited about it. If you want to learn about office product, Boston Properties. Data centers, pick one of them. It's all there. Multifamily, the public companies are a great way to look at this stuff and learn. You gotta know Excel. You gotta be comfortable with numbers. All of us have interns. We have a really good intern program. We now have our first managing directors that started as interns. We're in the office. We have 30 people under 30. And it's an incredible group. If any of you guys are interested, let me know. Mike hopefully will be back. He's the guy who, no one lets me hire anyone. But it's if you have the warehouse bug, we'd love to talk to you. Be open to going anywhere. Be able to grab a backpack and hop on a plane and go work. I'm opening our office in Tokyo. That's really exciting right now. There are 40 million people there, and they are way behind LA. And so, but just go for it. Go spend 2 years and work in Amsterdam, London. That's going to make you more valuable. So
I think that was the best point. Find out what sector you like. You love. We like industrial. You might hate it. You might like multifamily. So figure out what you like.
Thank you guys. Does anyone have any last minute questions before we wrap up?